Welcome to Chapter 4, Analysis of Financial Statements. And in today's chapter, we'll continue with our discussion on the basics of financial statements that we had covered in the previous chapter. Specifically, we'd like to understand how we can best use the understanding that we gathered about financial statements. So we look at things such as ratio analysis. We'll also look at the concept of DuPont equation and how it is used in understanding efficiency levels for production, and also specifically in terms of the financial performance of a firm. And then we look at the effects of improving ratios, general discussion of how to best use the ratios and limitation of ratio analysis, and then qualitative factors. So this is a mock balance sheet that we'll use for our discussion today, and we'll be looking at a actual 2015 and then estimate of 2016. So comparing the different aspects, and this is the liability and equity side of the same balance sheet. So just a quick refresher, we can see that we're starting in the order of liquidity. That is how liquid the asset is, starting from cash, accounts receivable, inventories, and that's going to give us the total current assets. Then we have the gross fixed assets, less depreciation, net fixed asset, and then total assets. And if you need a refresher, I would suggest go back to the previous chapter where we've discussed all of these components in detail. Some of the quick comparisons that we can see at a glance, that cash is supposed to increase from $7,282 to $85,000. So, and that's an estimate, that's why there's an E. But nevertheless, that seems like a good return, in terms of coming back to a healthy cash situation for the firm. Because if you recall in the mock statements that we had discussed in chapter 3, there seem to be some problems related to the cash levels of the firm. We see that the accounts receivable is increasing, and so is the inventory. The gross fixed assets have declined, or they're expected to decline. As you can see, they are going down from $1,202,000 approximately to $1,197,000 in 2016. That's an estimate. Depreciation is a bigger amount, and we also have net fixed asset. That is a combined number for the total current asset plus gross fixed asset less depreciation. So we can quickly, so you have cash, accounts receivable, you have inventory, then total current asset, gross fixed asset less depreciation, then you have net fixed asset, and then total asset. So this is for 2016 estimate. You got 2015. So you have 85,632, 7282, 878, then you got 632160. Inventories is 17164801287,360, and this will be a combined total of the above, and I can just copy it here, and then you got this as the total current assets, gross fixed asset 11,971,602,295,0, depreciation 380,120,263,160. So this is going to be the fixed asset minus depreciation, and then this would be gross fixed asset minus depreciation. Okay. Gross fixed asset minus depreciation. There you go. And total asset is going to be the total of total current asset plus the net fixed asset. And the same thing, just copy it here. So there you go. So we have recreated our asset side. And then similarly, we can create the balance sheet, which I'll let you glance over and recreate looking at what we had discussion in the prior chapter, because the focus of this chapter is going to be continuation of what we had discussed in chapter 3. But nevertheless, since we have done for the asset side, I'll quickly also recreate the balance sheet that is on the liability and the equity side. We got the accounts payable, accruals, notes payable, and we got total current liability, long-term debt, and then you got common stock, we got retained earnings, we got total equity, and then total liabilities and equity. So I can clear this off. So again, this is 2016 estimate. You got 2015 accounts payable. What we still have to pay to our suppliers, which we haven't paid. This seems to have decreased or is expected to decrease in 2016 accruals, which has to be paid once, which we haven't paid. Could be leases, rent, and so forth is accrued. You got so total current liabilities is going to be a combination of these three items, and this is expected to go down, which is a good thing, because these are liabilities. Long-term debt, you can see, is substantially expected to go down. Again, it's a good thing, because too much of debt is quite risky, because I had explained that you got contractual obligations on these debt instruments. For example, you can't get away by saying we didn't make money, so let's skip a contractual yearly or semi-annually coupon payment. That has to be paid. Common stock, on the other hand, dividends, if company doesn't make money, you don't have to pay dividends, because that's money being distributed with the shareholders or the owners of the firm. So 1721176 460,000. So basically, if you observed, the company is expected to issue more common stock. You see the number going up from 460 to 1721 in 2016. and that money is being used now to retire some of the debt, which, as I discussed, that there are two ways of raising capital funds. One is go and get long-term debt, or bring in more partners, or issue more stocks. So 231,176. So the retained earnings is also going to, or projected to, go up, which is a good thing. So total equity is going to be a combination of common stock and retained earnings, because this is the net worth of the shareholders on the book of the firm. And then total liabilities plus equity is going to be the current liability plus long-term debt plus total equity. And I can simply just copy over, and then there you go. So we have been able to recreate the balance sheet that was shown here. So let me just pull it here. There you go. So now it should be visible. Obviously we know that it's set up correctly, because our total assets are equal to total liability plus equity. So that way we know that it's the identity, the balance sheet identity is holding, and our setup is correct. Income statement. So again, we've been given the income statement. There's one for 2015, and then going over to 2016 estimate. Remember, you always start with sales less cost of goods sold, which is the number presented here, and then other expenses, which like we had discussed, advertising or some other expenses that have gone on to producing the goods, which have reported those sales figure, because it's always a matching principle that is used. Then earnings before interest, taxes, depreciation and amortization. EBITDA is 609, 608 for estimates of 16, and negative 13,988 for 2015. So a whole lot different scenario. You see that from a loss of 13,988 in 15, it's expected to turn around for a profit of EBITDA of 609, 608. Profit is still to be awaited because of taxes and other things, interest and taxes. Depreciation and amortization, again, remember that depreciation is an expense which the company charges back, is not paid out to anyone. So the earnings before interest and taxes number, then you got interest expenses, that's to be paid for the debt that the company is holding. Obviously, since a large amount of debt is to be retired, so the interest expense is also coming down. Earnings before taxes, then taxes, which is to be deducted, and then you get the net income. So moving on, we have other data which is given to us, which is number of shares. You can see that they are expected to increase from 100,000 15 to 250,000 in 16 estimate. Earnings per share from a negative number in 15 to 1.014, that's an earning estimate. Dividend per share is expected to be doubled, from 15 to 16. So instead of 11 cents, shareholders are expected to receive 22 cents per share as dividend per share. Stock price, which is currently at 2.25, is expected to increase to 12.17, primarily because of this improved performance of the company and the expected dividend, that's a cash flow coming on to the shareholders. And we'll discuss this in detail when we come to the stocks chapter. that the present price of the stock is not really dependent on the past performance of the firm, but the future expectation of cash flows or free cash flows which comes in. Lease payments are the same, 40,000 for the 2 years. So let's now discuss about the usefulness of ratios. I mean, why do we have to really deal with ratios? Ratios standardize numbers and facilitate comparisons. They make comparisons easy. And let me give you a very simple example. Let's say you're trying to decide between a relatively new firm which may have just started in the last 5 years, yet it's making money. Maybe it's a $3 billion firm and it's just new, versus let's say Amazon, which is close to $1 trillion firm. So how do you make a comparison between a relatively small firm? I mean, by no means $3 billion is not a small amount, but relative to $1 trillion, it's a small amount. So how do you make that judgment? Which firm should you invest in? I mean, because obviously when you look at the profit of Amazon compared to a $3 billion firm, on paper, on number, there's going to be a huge difference. One way you can do that is by calculating ratio, that is, in different forms, and then standardize the numbers to see which is a better performance. For example, if I score you on an exam which is giving you a grade score of maximum of 10, I mean 7 out of 10 is better, or let's say 65 out of 100 is better. So how do you make that judgment? Obviously, if you were to calculate a percentage between the two, you'll be able to find that which is a better number. So for example, if I just were to take 7 out of 10, that's 70%, compared to 65 out of 100, that's 65%. So you know exactly that the first one is a better performance, even though it was only out of 10. So this is how ratios are able to standardize and provide you with meaningful information that can be compared. Ratios are used to highlight weaknesses and strengths. So by making those comparisons easy, the weaknesses and strengths become rather easy for us to understand. Ratio comparison should be made through time and with comparators. That is, there has to be a benchmark. So for example, if I want to compare whether I did better than the previous term, then there has to be a base year from which I can make those comparisons easy. Something very simple can be your own GPA that you're trying to compare from semester to semester. So you take a base semester and then you compare your scores in the current semester based on the previous semesters. Or if you would wish to just compare your score to all the other average of all the other students in the class, and that again is a valid comparison. Comparators for firms could be industry analysis. That is, for example, is Intel's performance better compared to its industry comparators like AMD, which are both processor manufacturing firms. So which one is providing you better return on asset or better return on equity and so forth, which we'll soon try to understand. Benchmark peer analysis, again, which one is seemingly doing better. Trend analysis, that is over a period of time to compare these ratios. Are they going up, down, and so forth. Again, having a better ratio does not necessarily mean it's a good thing. It could be a bad thing, or vice versa. So there are 5 major categories of ratios and the question they answer. You could look at these ratios in different ways. The first one is liquidity. That is, can we make the required payments? And liquidity necessarily is, these ratios answer the financial performance of the firm in short run. When we say short run, anything under 1 year is related to short run. Asset management, right amount of assets versus sales. That is, are we making the best use of the assets we have in terms of the sales that we generate based on the assets that we normally have purchased and are maintaining. And we'll discuss the relevance of that in today's environment, where you'd find most of the businesses, they like to rely on third parties for manufacturing. They try to keep their own assets as lean, less to a point as possible, so that their asset management numbers look good. Plus, it cuts down on a lot of overheads, in terms of asset management and so forth, in terms of real management of assets. Debt management is the right mix of debt and equity. As I mentioned, that debt can be a signal of risk. So having too much of debt is not necessarily seen or viewed as a good thing. Profitability: do sales prices exceed unit costs? And are sales high enough as reflected in the return on equity or return on asset, profitability margins, and so forth. Market value: do investors like what they see as reflected in the price earning and market to book ratios? And all of these, we'll cover one by one. So let's look at De Leon's, our case company. From the previous chapter, De Leon's forecasted current ratio and quick ratio for 2015. And we start with what is known as the current ratio. Now, current ratio is equal to current assets divided by current liabilities. And I'll again show you, how to get these numbers. So for example, we had already calculated total current assets. Here you go. These are the numbers that we are looking at. Total current liabilities, these are the numbers we're looking at. So if you had to calculate the ratio, so for example, we have, in this case, or in this instance, the current ratio being calculated for 2016 estimate. So we can simply, take the current assets divided by total, current liabilities. And there you go. We got 2.34 times. So what that means is our current ratio, which is 2.34 times, is seemingly very well situated to cover our current liabilities. So for example, if we had to pay notes payable, the accruals, or accounts payable, our current assets are 2.34 times our current liability. So we could, relatively in an easy fashion cover our current liabilities. This is how it's to be used. That's why you got that X there. It's read out as 2.34 times. Then you have quick ratio, because remember I had discussed about the issue of inventory. So even though inventory is placed in the current assets, inventories are not easily disposed of in case you wanted to sell. If the product is not in demand in the market, even though it seems like your inventories can be converted into cash quite easily, this is not the case in reality. So to really look at the ratio, this ratio, practically we decide to subtract the inventory level from current assets. So what that means is taking total current assets minus inventory, and I can just put that in a bracket, divided by current liabilities, which is this number. And now you see that we have 0.84 times. This is, you can just take off the dollar sign because that was the thing we had used earlier. There you go. So 0.84 times. Now see how easily the whole situation has changed, because if we deduct or subtract the inventory level, now we are in a dire situation because our total current liabilities are more than current assets. So for example, if let's say we did not make enough, if we don't have enough cash for some reason, or our clients or our suppliers, our clients who need to pay us for accounts receivable and they don't for some reason, we'll be in serious problem, because the rule of thumb is that you should have at least as much of current assets as current liabilities. That's a minimum to cover or have the status quo. So in this case, it's below 1, which is not good. So the same situation, but let's compare this with 2015. So I take my total current assets less inventory and divided by 2015 current liabilities. Okay, so now you can see that it was even worse in 2015. So we have improved quite a bit, but there's a long way to go, because we'd like to have this ratio to be at least 1 to be able to cover all of the liabilities, current liabilities that we have. But we are expected to do a whole lot better in 2016 than compared to where we were in 2015. So this number is 2015, and this is the estimate for 2016. So let's compare. This is the trend and benchmarking that we had discussed. So current ratio estimate, we had calculated 2.34, quick ratio is 0.84, and this is the comparison given to you. Industry average is 2.7. So we have a long way to go, even for meeting our ratios to the industry average ratio, the current ratio. And then, like I said, for quick ratio, you'd want to be at least at 1, where the industry is currently showing, for a average quick ratio, and we are still way below. But you can see that it was much worse in 15. It was better in 2014, but went much worse because of the expansion projects that we had discussed in the previous chapter. But it seems to be picking up in 16, but there's a long way to go. So expected to improve, but still below industry average, and we can say that the liquidity position is weak. Now we come to the inventory turnover, which is sales divided by inventories. That is, how fast can you convert your inventory into sales? And this you get by taking the sales number divided by total inventory. And again, the sales number is going to come from the income statement. So there you go. You got the income statement, which is 7035600, and that so there you go. You got the sales divided by inventory, which is 4.10 times. So again, we take off the, that is roughly, your sales are 4.10 times of inventory, or you can say that takes approximately 4 months. I mean, however you want to interpret, it's taking the sales are about 4.10 times your inventory. Obviously, the higher the number, the better, because you'd like to have this inventory converted into sales as fast as possible. That is, number of times a year that you're converting your inventory into sales. So the higher the number, the better. In case we see this, you have 4.10 times, industry 6.10. So again, there's a long way to go. So inventory turnover is below industry average, as we had seen. There you go. DeLeon might have old inventory, or its control might be poor. No improvement is currently forecasted. So you can see that between 15 and 16, they are actually in 16 estimate is lower than 15. So what recommendations could you give the managers at DeLeon? That hey, if you want to improve the number of sales times inventory over a period of year, then maybe you can have sale or clearance, or have some better credit terms for your buyers, so that inventory can really clear out, and you can have a better sales over inventory or inventory turnover number. So days, average number of days after making a sale before receiving cash, and that is given by receivables divided by average sales per day. Now we know that we have the sales figure, the annual sale, which we can get from the income statement. There you go. So we already have that number, which is 7035600 divided by 365. So that gives you an average of daily sale number. So this, I've calculated the right hand side of this equation. Receivables is going to be the accounts receivables. We have already identified for the 16 estimate, which is 878000. So all I need to do is just take my accounts receivable divided by the number that I've calculated here. So this is going to be 45.55 days. So it'll take you about 45.55 days before your sales is getting converted into cash. Obviously, in this case, the lower the number, the better, because more number means it's taking more time for you to recover funds. And how can you reduce this number? Well, maybe you can give some discount, that if you settle your bills in 15 days, we are willing to give you a 3% discount. Or if you're willing to convert your bill into cash to us in 30 days, we'll give you 5% discount or 2% discount, whatever it works for having your customers pay you or send you cash or payment for what they purchased at an earlier time frame. So comparing, you see that DeLeon collects on sales too slowly. Maybe you need to also provide some incentive to your sales team, that hey, go out and discuss with the buyers as to how they can get us cash as soon as possible. So DeLeon has a poor credit policy. Maybe they are too liberal on credit policy. They are not collecting cash as fast as needed. Industry average is 32 days, whereas DeLeon is estimated to collect cash, convert their sales into cash in 45.55 days. Fixed asset and total asset turnover ratios versus the industry average. Now, fixed assets are the capital investments of the company, for example, plant, building, machinery, and so forth. So how's that investment being utilized for sales? And that we can get by taking the sales number divided by net fixed asset. And obviously the sales number is coming from the income statement, and it's condensed from the 7 million mark, just they've taken off the zero. So we'll do the same thing. You'll get approximately a similar number. So 7036 divided by the net fixed asset, In 2016 estimate is 817. There you go. You see this here, 817. So divide by 817, and I get a number of 8.61. So you are utilizing, or you are converting, your sales are 8.61 times the net fixed asset that you have made investment in. Obviously, in this case, again, higher the number, the better, because you'd like to make as much of sale as possible utilizing your assets. Total asset turnover. So total assets are this combined number, 3497152, and again 7036 divided by 3497. Again, not to confuse, what's been done in this example is that only the first 4 digits have been used, and after that, just to make it easy for calculation, should give you approximately the same similar result. So it's 2.01 times. So you're making sales which are 2.01 times compared to your total assets. Obviously, again, the higher the number, the better. I mean, if I'm able to get three times my total asset, it's better. 4 times is even more better. And then 5 times, 6 times is what I might aim, and so forth in long term. So again, companies, managers, to window dress or to make these numbers look good, imagine the trend that's happening right now is they're doing away with all of those fixed assets. So if the fixed asset number, the denominator, is lower, obviously the fixed asset turnover and total asset turnover is going to look better, in terms of ratio. So comparing with industry, let's see. So fixed asset turnover is better than industry average, because industry average is 7, whereas DeLeon is 8.61, which is good. And total asset turnover is lower than industry. Industry is 2.6, whereas DeLeon's is 2.01. So what is really pulling this down? I think it's the inventory, which is a higher number, and also accounts receivable. So fixed asset turnover projected to exceed industry average, total asset turnover below the industry average. This is caused by excessive current assets, the inventory and accounts receivable as just identified. So you can see this. If you are a manager at DeLeon, what you want to do is to somehow curtail, these two numbers, which is accounts receivable and inventory. I think the inventory is a big culprit. That has to be cleaned out. I mean, if the inventory cleans out, then your numbers would automatically look good. Debt to capital ratio, that is the debt that the company has taken, what ratio or what percentage is compared to total invested capital. So that we can get from the total debt, which is coming from this long-term debt and notes payable. Remember, notes payable, even though it's a short-term debt, but still debt. I'll show you. This is long-term debt and this is short-term debt. And then total invested capital is going to be a total of notes payable, long-term debt, and the total equity, which is owners share in the firm. So this is where these numbers are coming from. So let's quickly calculate this. So total debt is going to be 400,000 plus 300,000 divided by 300,000 plus 400,000 plus the 1,952,000 odd number, which is owner's equity, and this is going to be 26.39 times. So let me just take it number. There you go. So you see 0.26 times. So the debt to capital is roughly about 26.39 times, which is okay, because normally higher the debt compared to capital ratio is not good. So when we compare it with industry average, we'll be able to give a better answer. But for now, we can say that it is a good number. But let's see what it compares to industry average. Times interest earned, that is, are you well situated to pay interest that you have to pay on this debt? Because remember, debt is the contractual obligation of the debt is something that you cannot escape. You have to pay, otherwise the debt, the bond holder or the debt holder of your company can take you to court and force you into bankruptcy. So generally you'd want to know how many times the interest that you're obliged to pay are you really earning, and that comes from EBIT, which is earnings before interest and taxes. That comes from the income statement, and we can go to the income statement. So this is EBIT, income statement 492,648. So this is 492. I'm just going to write it 492,648. This is earnings before interest and taxes. And let's go back. And the interest that you pay, again, this is going to come from the income statement. So let's go back. There you go, the income. This is the interest that you're paying, interest expense. This is 70008. This is the interest expense. So times interest earned, that is how many times the interest that you have to pay are you really earning, and this is going to be this number divided by interest expense. So 7.03 times approximately, which seems to be okay. I mean, you are well covered. There you go, 7.04 times. But let's compare to industry. Now, debt to total inventory capital is, in our situation, 26.39%. Industry is 40%, which is better than industry, because remember, you'd like to have this number as low as possible, the debt to total invested capital number. In comparison to times interest earned, you are 7.04 times compared to industry average of 6.20, and that is also good, because you're earning a lot more to cover your interest than industry average. So total invested capital, which is the combination of the total debt plus the owner's equity, and debt is just debt. So both of these numbers look better than industry average. Now let's look at the profitability ratios. Let me take another sheet. So profitability ratios, primarily these are going to come from the income statement. You have the operating margin, profit margin, and the basic earning power. In case of operating margin, it's earning before interest and taxes, which is 492.6. Now this is coming from the income statement again, divided by total sales, which is 7036. So your earnings before interest and taxes compared to your total sales is 7%. Now obviously you'd like to have this number as high as possible. Why? Because the more as a percentage of your sale you can keep as EBIT, the better. because then you're reducing your expenses. That's why you see the trend of a lot of companies moving away from the US to other cheaper labor markets or other cheaper markets where they can produce, because the total cost of goods sold or other expenses can be reduced. Profit margin, again coming from the income statement. In this case, the profit margin is going to be the net income. That is the bottom line, and I'll show you where that comes from. There you go, net income. So this is your net income. So here you go, net income. And again, the trailing numbers have just been condensed to make it easier to calculate, and just right here, divided by 7036. That's the total sales. This is 3%, approximately 3.60%. Again, is it good? Obviously, you'd like this profit margin to be as high as possible, but then some industries, by the virtue of how they are, what sector they are in, you don't have a higher profit margin, and also related to the competition. For example, grocery, retail business, it's highly competitive, and if you can get anywhere between 7 to 10% of profit margin, you'd be more than happy. On the other hand, companies, for example, like internet companies, they could have a much higher profit margins. Or software development companies, which are well established, they could be charging well over 20-30% or more. Or even financials, which make a very high profit margin. So it also depends on which sector the company is placed in. Now, basic earning power is EBIT divided by total assets. Now, EBIT is going to come from income statement, and total assets obviously is going to come from the balance sheet. So in this case, it is 492.6 divided by 3497. And again, the more you practice, the more you familiarize yourself as to where these numbers are coming from, the easier it'll get. So it just will come to you in case you memorize or at least write down the basic components of various financial statements, and keep it like a cheat sheet. Okay, this is on the balance sheet, this is on income statement, and as and when you get such questions, or as and when you have to practice, you could look at that basic card and see where these numbers are coming from, and that'll become easy. And the rest is simple division, and that is not a big problem at all. So in this case, basic earning power is 14.09. Let's see what it compares in case any numbers are given for comparisons to industry. So here you go. You got operating margin of 7, which is right below industry, but not too far away. But look at how well the company is expected to do. I mean, in 15 it was negative 2.17. Now it's 7%, which is a whole lot better. Profit margin was negative 2.65. Now it's 3.6, which is going to be better than industry. Industry is only 3.5. Basic earning power compared to the total assets is 14.09, which is a whole lot better than negative 4.57, though the number is still little less than industry average. So you want this number to grow higher. Obviously, if you were to reduce your total inventory and total accounts receivable, you would have the basic earning power go even further higher. So my recommendation to the manager in this case would be reduce your inventory level, reduce your accounts receivable by giving incentive to customers to purchase any inventory that's lying by clearances or sale, or giving them some discount, and tell your marketing team to go out and get your clients to pay by offering them some discounts or something. As soon as those two numbers come down, your basic earning power will go better, and this will be better than the industry average. So this is how you need to start understanding these numbers and explanation. So praising profitability with operating margin, profit margin, and basic earning power. Operating margin was very bad in 15, as we discussed. It is projected to improve in 16, but it is still projected to remain below industry average. Profit margin was very bad in 15, but it's projected to exceed the industry average in 16, so it's looking good. Basic earning power removes the effect of taxes and financial leverage and is useful for comparison. The BEP projected to improve, yet still below industry average. There is definitely room for improvement, and I did mention how actually it could be done relatively in a fast way. That's why if you kind of observe, almost all car dealers would be giving massive discounts to clear off inventory at least 3 to 4 times a year. The big one obviously comes year end, where because the models are being changed, but even during the year, you have the Columbus Day sale or President's Day sale or Independence Day sale and so forth, Thanksgiving, Black Friday sale. So those are major, kind of step of the way where the dealers are trying to clear off inventory to make their, basic earning power and these numbers look good. Let's look at some other asset related ratios. The first one is return on asset, which is simply net income. Net income again is going to come from the income statement, which we had just taken. So it's 253.6 divided by total assets, which again is going to come from the balance sheet, is 3497, and this is roughly 7.25%. And again, is it good or bad? Well, again, it depends on the nature of industry. For example, in certain instances, industry is quite heavy on asset side, like manufacturing, car manufacturing. Car manufacturers have to invest a lot of money in building plants. That's why it's not an easy industry to work in. Plus, it's also highly competitive. Look at all the car manufacturers we have. They're all trying to compete for the same market. Now, on the other hand, look at some of the software development companies. I mean, what sort of assets do you really need for a software development company? I mean, if it's a small firm, you can have 4 or 5 programmers simply just hire a loft or abandoned building at relatively low rent, get high speed internet access, furnish it a little bit, and have laptops or desktops, and you are in business. Compare to that, your return on asset for a IT sector firm is always going to look better than, let's say, a car manufacturing firm. So it depends a whole lot on the type of sector the firm is in. Return on equity, that is compared to the total common equity of the shareholders. In this case, net income is again coming from the income statement. Total common equity is coming from the liability and equity side of the balance sheet. And this is going to be 253.6 divided by 1952. That's roughly about 2.99%, which is approximately 13%. That's return on equity. I will be discussing this in quite detail later on, but just to kind of give you an example of how we can make this as a relevant number when making investing decision. So what you can do is look at the projected, total common equity and projected net income for the coming year between 2 or 3 different companies and see which one is providing you with a better ROE, and then make investing decision as to, okay, which company should you invest in. Obviously, the company that provides you with the best or the highest ROE is the one that you should invest in. So again, all these numbers, ROA, higher the number, the better. ROE, higher the number, the better. ROIC, return on invested capital, this is going to be EBIT minus the taxes divided by total invested capital is going to give you ROIC. So you're trying to now take away the tax treatment. So EBIT is going to come from income statement 295.6 divided by 1 minus tax, which I believe should be, I'm sorry, this is going to be so let me make sure that I'm getting the right number. EBIT is going to come from the income statement. So coming back to the income statement, there you go. So EBIT here is earnings before EBT. So let's see, this is 422,640 earnings before taxes. And what have they taken here? So EBIT 295 so EBIT, so let's go back and see what the EBIT number is. That was even higher. There you go. So EBIT is 492,648 multiplied with 1 minus, I'm going to assume 40% is the tax rate. Let's see if this is correct. Yeah, so that is how you get the number. I believe what they did was they gave you the answer on the PowerPoint, not letting you know how to calculate. So you take the EBIT, which is 492,648, and then deduct 1 minus the 40%, which is the tax rate that and the PowerPoint is assumed. So there you go, that's the number that we get. And obviously, since they did not take the complete total number, that's we're getting that longer result. So this I can take off 1, 2, 3. There you go, 295 point. Took off the last 3. That's why it's a little bit off on the after decimal. So this divided by the total invested capital, which is 2652.4. If you took the exact numbers, it'll come exactly the same. Since I took off the last 3 numbers off, that's why I'm getting a little bit of deviation, but we're getting the same result, approximately the same. So 11.13, which is 11.14 here, which is approximately the same. So again, ROIC, the higher the number, the better. So let's compare appraising profitability with ROA, ROE, and ROIC. You got ROA, which is 7.25%. That's an estimate. ROE 12.99%, 11.14%. ROIC, which is, a lot better than 2015. Look, all the numbers were really bad in 15. They're all negative numbers, which is not good. Compared to industry average, still a long way to go. I mean, industry average, they are doing a whole lot better for utilization of assets, whole lot better in utilization of equity, and whole lot better on ROIC. So all ratios rebounded from the previous year, but they are still below the industry average. More improvement is needed. Wide variation in ROE illustrates that effect, that leverage can have on profitability. So higher debt can mean, lower profitability. Why? Because a major component is being paid out as interest, even though you're taking, tax break because of the interest you paid, but the profitability is impacted. Effect of debt on ROA and ROE. Holding assets constant, if debt increases, equity declines. Interest expenses increase, which leads to a reduction in net income. If ROA declines due to reduction in net income, and ROE may increase or decrease since both net income and equity decline. So you see the impact here, or the relationship here. Problems with ROE. ROE and shareholder wealth are correlated, but problems can arise when ROE is the sole measure of performance, because ROE does not consider risk, how much of risk a firm is taking. ROE also does not consider the amount of capital invested. Since these, given these problems, reliance on ROE may encourage managers to make investments that do not benefit shareholder, because, you'd want to make as much of return as possible without giving due consideration to the risk, because you want to show a better return on equity. And that is why, we had the whole aspect of recent financial crisis, because managers were making undue choices for investing in the subprime mortgages, and that resulted in ultimate problems for large financial institutions and so forth. So as a result, analysts have looked up to develop other performance measures such as economic value added. Calculate the price earning and market to book ratio. So price earning, we had done this in the previous chapter. Price is the stock price, and this is from the other data that was given. And let me open up another worksheet. So you get the estimate of the share price of the firm, which is 12.17, divided by earnings per share. Again, this is on the other data sheet, and that is 1.014. So price is 12 times. That is, a market is willing to pay approximately 12 times the earning potential of the share. The higher, obviously, the better for shareholders. Higher is not necessarily better for the buyers of the share, but higher is definitely better for the case of shareholders, who are holding, because their market value of their shareholdings is going up. Market to book value, market price is the market share price divided by the book value per share, which is the total equity divided by number of shares. So this is going to be 12.17. This is the share price in the market, and the value of the share on the book is going to be the total equity, 1950 divided by 250. So this is on the book, 7.8, and you can take this divided by this. So the market value is 1.56 times, which is good, because on book the value of each share is $7.8, whereas in the market is 12.17. So the managers have done really good job of increasing the value, book value in the market. But let's see how it compares to the industry. So even though things have improved from the previous year, from negative 1.4 to 12 times in price earning, it's still below industry average of 14.2. So some way to go. Market to book from 0.46 has gone to 1.56, but then from industry it has gone down. So Just want to make sure one thing on the balance sheet. Let's see, on the liability and the equity side. There you go. That's the income statement. There you go. So here you go. Total equity 1.952. This is what you're taking, the total equity. That's on the book. This is what the shareholders own in the company on book. So this is their holding, their net worth in the company. And then other data was given on the sheet. I think this is the other data. So this is what's coming from the other data. Number of shares, and then the stock price, and so forth. So analyzing the market value ratios, price earning, how much investors are willing to pay for every dollar of earning. In this case, it's 12.17 times, which is quite good. Market to book, how much investors are willing to pay for every dollar of book value of equity. Again, that's 1.56 times. So managers have done a good job of increasing the net worth of owners, but again, a lot to go. For each ratio, the higher the number, the better. Price earning and market to book value are high if expected growth is high and the risk is low. Now we can also use DuPont equation to arrive at return on equity, and this was introduced and basically formulated at the chemical company DuPont, and hence the name DuPont equation, sometimes also called as DuPont analysis, to arrive at return on equity. That comes from profit margin, which is net income divided by sales, total asset turnover, which is sales divided by total assets, and equity multiplier, which is total assets divided by equity. So this focuses on expense control, profit margin, asset utilization, and debt utilization. So, we can take an example. So, for example, if you want to calculate ROE in this case, it's a simple multiplication of, or first calculating net income divided by total sales, multiplied by sales divided by total assets divided by total equity. I can simply just first do the calculation. 3.6 multiplied by 2.01 multiplied with 1.7913. There you go. So now I have 12.96%, and if you round off, that's going to be 13%. So this is going to give you return on equity by using DuPont analysis. This is of relatively good importance when you look at this analysis in some of the higher level classes. For this particular class, we just want you to understand what DuPont analysis, what the breakdown is, and be able to compute a simple question based on this equation, which is net income divided by sales multiplied by sales divided by total asset multiplied by total assets divided by equity. Because if you look at it, this cancels out. Total asset to total asset, that cancels out, and then sales by sales, that cancels out. So what you get is net income divided by equity, which is your return on equity. So now you see how this DuPont analysis has been calculated, and still it gives you return on equity. An example, the effects of improving ratios. So you have this given: sales per day is equal to 7035600 divided by 365, which is 19,275.62. So reducing accounts receivable will have no effect on sales. Old accounts receivable is this number, and new accounts receivable is this number. So cash freed up is going to be 261,180. So we're looking at different scenarios. So if we were to, let's say, have our days to convert the sales, DSO, how would that affect the company? You can see this. Cash is freed up because we are converting our accounts receivable faster into cash. Earlier it was taking 45.6 days, now it's 32 days. So since we're getting the cash converted faster, we are now able to reduce our accounts receivable overall, and that is going to provide the critical 261,180 as to cash. So initially shows up as addition to the cash. So what would be done with the new cash? How might stock price and risk be affected? So now that you have this additional cash which has been added to your total, how could you use this cash? You could simply keep it as cash in hand, but if you were to make a good choices, you could repurchase stock. That is, you could go out and buy stock of the firm, and the way it works is by purchasing stock of the firm in the market, you're reducing the total number of stocks in the market. That automatically is going to bump up the stock price of the firm. Expand the business. You could use the cash and use it to set up or expand more stores or launch new products and so forth. But that necessarily may not be a good idea immediately if you have too much of inventory. That is, the last time you did that, your sales did not pick up. So maybe you want to invest that money into developing new products like Apple did. Apple, when it was close to bankruptcy early, close to 2000, when Steve Jobs was called back, the first thing he did was he freed up a lot of inventory by shutting down the products that were not selling. He concentrated simply on the lineup of MacBooks. He concentrated simply on the lineup of Mac Pro, the desktop, and he shut down the server division. He shut down some of the other models which were not selling, and he concentrated on iPod, which was a massive success, and then later on iPhone and so forth. So he put in a lot of money in research and development. So that should what businesses really should do in case their current inventory is not selling. Reduce debt. That obviously helps because you're reducing the total liabilities of the firm and reducing the risk of the firm. All these actions would likely improve the stock price because in market it will provide signal that the company is moving towards the right financial situation. Potential problems and limitations of financial ratio analysis. Comparison with the industry average is difficult for a conglomerate firm that operates in many different divisions. These are big firms that have a lot of divisions, and it's difficult to compare such a firm with a sector. For example, 3M. 3M is not just a stationary producing business. It's into chemicals, it's into pharmaceutical, it's into medical equipment, it's into manufacturing, engineering, and so forth. So how do you compare 3M with other firms? You basically cannot do it. Different operating and accounting practices can distort comparisons. For example, a company in the US may have a different accounting practice than, let's say, a company over in Europe or Russia and so forth, where you may have different ways of taking expense and even the taxes. The tax ratio might be different, so that distorts the operating profitability margins and so forth. Sometimes it's hard to tell if ratio is good or bad. Difficult to tell whether a company is on balance, is on balance in strong or weak position. Average performance is not necessarily good, perhaps the firm should aim higher. Seasonal factors can distort ratios. So, for example, some of the clothing manufacturing companies like North Face or Canada Goose may perform really well during winter months and not during summer or other season, because that's the nature of business. Now, how do you compare? For example, if you're comparing performance of these firms in non-seasonal months, is that really a good way to compare these firms? Window dressing techniques can make statements and ratios look better than they actually are. Statistically, if you just make some changes, or some companies, what they do is they would show pre-sale as in current quarter, and that would look good. Pre-sale is basically your booking orders, but they have not actually shipped out. They have not actually shipped out. So you could show them as accounts receivable, whereas those orders are still lying in your warehouse. Now, technically, yes, maybe you're booked and they're waiting for dispatch, but an order really is not sold until it's left your warehouse or has reached the buyer, who may sign off on receivable. Inflation has distorted many firms' balance sheets, so an analysis must be interpreted with judgment. Consider qualitative factors when evaluating companies' future performance. So are firms' revenues tied to one key customer, product, or supplier? I mean, for example, we had the recent situation of many firms who were tied to GM, and when GM filed for bankruptcy, these firms, which otherwise looked so well on paper, suddenly collapsed because they only had GM as this major buyer. What percentage of firms' businesses generated overseas? That is another situation which is relevant these days when we're talking about trade wars or import duties being levied. So, for example, if there's a firm which is heavily dependent on exports to Europe, and if suddenly Europe starts putting taxes on import of goods of those firms, then their ratios, for especially the profitability ratios, are going to be, in a big problem. Firms' competitive environment, taxes can have problems, currency exchange rates will have problems. If there's a slowdown of the economy, the slowdown of a major market, they all will have an impact. Future prospects, what sort of markets does a product really have in future? For example, not too long ago, I don't know if you recall, a company called Blockbuster was a big name in rental business, DVD rental business. But the way Redbox, started putting kiosks and making it easy for people to rent DVDs, or even at that, companies like Amazon Prime or Netflix, they've been making it very easy for customers to stream directly to home and devices. There is no need for companies like Blockbuster anymore. So all these were great companies. They were profitable companies, but that's the nature of business that's changed. Legal and regulatory environment, tobacco products or liquor and so forth. If they suddenly have governments come in who might put a lot of taxes or levies on such products, then it could again impact their profitability and other ratios. So all these are relevant factors to consider when you're comparing ratio analysis and so forth. So that brings us to end of this chapter. If there are any additional questions, please let me know, and I'll see you in the next chapter. Thank you so much.